Hello, this is Kyle Tucker. You're welcome to What Every Radiologist Should Know About Medical Billing. Today we're going to talk about an insider's view about what you should know, the key minimum things you should know in order to keep an eye on your billing. Let me start with why you should listen to me, who I am. I've been in billing for 17 years, most of it in radiology. I own Dexios Radiology Billing. I've done a lot of billing analysis. People send me end-of-month reports, and I kind of tell them where they stand in their terms of their billing. I've also done consulting for radiology practices. I've actually moved on site and helped turn around radiology practices, help them get their billing in order. My company won the Imagine Software Customer of the Year in 2015. We also won the Most Improved Practice Award for a turnaround we did in 2014. And for those of you who are not familiar with Imagine Software, they bill for about 14,500 radiologists in the U.S. and have a 60% share in radiology. So we're very proud to have won those awards. But anyway, we're going to today about key performance indicators and benchmarks in the industry, what your billing company or your billing staff should be providing you at a minimum in terms of reporting. We're going to talk about why average might be fantastic or maybe horrible, and how you figure out what the difference between the two is. Give you some horror stories and some success stories from the last 17 years of some things I've been involved in. And then we're going to talk about some insider tricks of the trade. But before we begin, we're going to talk a little bit some things that you just need to know to put things in their proper context. And again, some of this you guys probably know, but I'm going to pretend like you really don't know anything. So if I'm too basic, I apologize. But there's a big difference between hospital-based radiologists and docs in a private imaging center. And when I'm talking about private imaging center here, I'm talking about in particular where you're globally billing, meaning it's physician-owned and you're billing both the technical and the professional component. The big difference between those two is the control of the patient. If you're in a hospital-based group and you've got an ER, you don't see the patient, you don't control the intake, getting the insurance information, et cetera. Whereas if you're in a private imaging center, you can do that. You can control the patient, get the appropriate information, collect some upfront money if people are self-pay. And so there's time of service collection. You also, after the procedure's performed, the study, then you have access to the data on the back end. That's not always the case in a hospital setting. That information may come over to the billing company or to your staff, and then they may not be able to get back into the hospital system, depending on the agreement that you have with the hospital. So that's a big indicator of how successful you're going to be. And when you're billing globally, you're going to see rates about half of what they are for professional billing, because they're billing twice as much for the procedure. So and you're going to collect a whole lot more when you're collecting for a private imaging center. The other big factor here that you need to be aware of going into this is patient mix. There's what I call true self-pay, people that just have no insurance. And of course, that's been lowered by Obamacare, but there's also been an influx of high deductible plans, which I call de facto self-pay. So if somebody has a $5,000, $6,000 deductible, and they come into the emergency room and present, and you do a scan on them. If they've got a $5,000 or $6,000 deductible, even though they have insurance, they're de facto self-pay. So they're going to be paying that out of pocket, and that's hard to collect. Anytime that the patient is responsible for a balance or they're responsible for the full amount, then that's harder money to collect than billing insurance. So let's talk about the number one key performance indicator in this process, and that's money in the bank. You're never going to see this on any charts or any industry rags, but I say this to radiologists and the radiology practice managers. Let's don't as we're looking into these key performance indicators, let's don't lose sight of what we're here for. Obviously you're there to provide a medical service for your patient, good quality medical care, but one of the reasons you're doing this is so you get paid for that service. So don't lose money. It's the money in the bank that is important. And so, how do you maximize money in the bank? Well, let's get our minds around this. So your true cost of billing, I would suggest to you, is your cost to bill. And what is your cost to bill? It's all the billing company fees, or if you're billing internally, it's all the costs associated with billing, statements and clearinghouses and employee cost and their retirement, their stationary, whatever it is. All those go into internal billing costs. And when you calculate those all up, that's your direct cost to bill. But on top of that, and this is a key concept to grasp, is that on top of that, whatever money you leave on the table is also a cost to bill. So let's say you're have the ability intrinsically within your practice, if everything was hitting on all cylinders in your billing department, to collect 95 cents on the dollar, but you're only collecting 90 cents on the dollar. Well, that 5 cents that you're leaving on the table is a cost of billing, because you're not optimizing your billing. You're leaving 5 cents per dollar on the table. That goes into your cost to bill. And then if you're really, not doing this well and you're sending a lot of money to the collection agency that your billing department could have collected, you have to add that back too. So any collection agency costs, and collection agencies, you're going to be paying, 20, 30 cents on the dollar for that. You got to add that back in too, because obviously you want to minimize what is left for the collection agency to collect. So here's a quick example. Let's say your direct billing costs, when you add everything together, is 7.2%, which is a professional component rate. And the collectible money that you're getting, plus let's add in a penalty, because maybe not all your doctors qualify for PQRS because your billing company or your billing staff wasn't doing that very well. Let's add another 7.4% to that. And then your collection agency fees, let's add 1% for that. So your true cost of billing is 15.6%. The point here is, don't just look at your direct billing costs as your cost to bill. You got to look at the money you're leaving on the table as well. And figuring that out is how to optimize your, which is net collection percentage for your patient mix. So the net collection percentage is the money that's possible to collect. So everybody has the opportunity to collect, $1, let's say. And if you're collecting 80 cents on the dollar, right, then that means you're leaving 20. But that may be a good number because of your patient mix. But let's back up to the calculation for a second. Gross charges minus contractual adjustments equals net charges. Then gross payments minus your refunds and return checks equals net payments. When you divide net payments by net charges, you get a net collection percentage, the money that is possible to collect, that you are collecting. So this number is often misunderstood because you gotta factor in, like I said before, the patient mix. So here was a quote from a blog by actually a friend of mine, business associate, who's a very knowledgeable guy, but he quoted the MGMA, and he said the MGMA suggests a net collection percentage of 95% or higher. If you're not meeting the standard, there's definitely room for improvement. So there's that quote. Well, that's not true. That could be true, right? If optimizing your billing is gives you an opportunity to collect more than 95%, then that's true. But let's say you're one of those guys that has 15% self-pay, true self-pay. You're not going to collect 95 cents on the dollar. You're just not going to do it. And you can keep throwing more and more billing expenses, direct billing expenses, hiring more people. But eventually there's a huge drop off, a diminishing return. You don't want to spend, $1.05 to collect $1, right? So that just doesn't make any sense. So eventually you got to cut that off. So in the end, it's net collection percentage is about optimizing net collection percentage for your patient mix. And again, the higher your self-pay, the worse your collection percentage is going to be. The less you can control the patient, the worse your collections are going to be. So just something you need to know. Benchmarks for this: professional hospital-based docs, the median is about 80% in the U.S. Global billing, private imaging centers is about 96%. So again, professional, 80 cents on the dollar is about median, and about 96 cents on the dollar is about median for global. So that's again, but that doesn't tell you what you should be doing. That just tells you what average is. And I would tell you this, average is just average, right? If you ever own a pro football team, you don't hear too many owners bragging about that we went 8-8 for the year. You might squeak into the playoffs if you're in a weak division, but for the most part, you're just middle of the road, and most times you're going to miss the playoffs. So that's not really if you're median, that's not really a number to brag about. But it could be if you had a horrible patient mix. If you hit, the median and your patient mix is way worse than other people's, then you might be happy to be average, right? So just keep that. So let me tell you a little couple war stories here. And here's one that is a for radiologists self-billing hospital-based group in a small town. And when they calculated all their costs together, their direct cost to bill, their direct cost was about 13.5%, which is really high for a direct cost of billing. Their net collection percentage was about 67%, which sounds bad, but in this case, with their patient mix, they had about true self-pay of about 10%. Maybe they could bump it up a little bit. I estimated about 75% is where they could land. So when you add all their true cost of billing together, what they're leaving on the table and their direct cost to bill, I calculated that their true cost to bill was about 21%. So if they optimized their billing, I think they could do that without raising their expenses, because they could actually do it by lowering their expenses. I estimated that their potential true cost of billing was about 8%. And if that could be realized, meaning that at an 8% fee or internal billing cost, they could optimize their billing, which I think is possible. For this group, it would mean about $500,000 annually in additional income. And in this case, these guys were kind of protecting an internal billing staff, which wasn't operating very efficiently. And so nothing really happened here. And as far as I know, they're still on this path. So the next key performance indicator is days in AR. Now, a lot of people put a whole lot of stock in days in AR, but I would tell you that days in AR can potentially be very, very overrated. Money in the bank and net collection percentage trump days in AR any given day. What I mean by that is to say that if we have to take a little bit longer to collect that money and make our days in AR bigger, then that's an excellent trade-off if we're putting more money in the bank. So it's just an indicator, and what it tells you is how quickly you're getting your money. It's your total receivables divided by your average daily gross charges, or days in AR, and that should be looked at with a view over about 6 months or a year, because if you look at it in a short term, it's going to give you these wildly erratic numbers. If you take just 1 month and divide your gross charges by your average daily gross charges, it's going to give you some erratic numbers. But you want to look at it over a longer period of time, and that'll tell you really kind of what your true numbers are. And you want to kind of watch the trend of it. Now, it's also important to understand that your policies that you establish, hopefully with your billing company or with your internal billing staff, are potentially going to affect days in AR. For example, if you have a very liberal payment plan policy, let's just be ridiculous and say, you'll accept a $5 a month payment for people. If somebody has a $500 balance, that's going to, extend your days in AR quite a bit by having that policy. Just understand it. I'm not saying don't, I'm not telling you how to establish a payment plan policy. Just saying be aware it's going to change your days in AR. Let's say you have a group that has high auto or workers comp. Those are notoriously slow paying, and let's say that you have a you don't make it patient responsibility right up front. So again, that'll extend your days in AR. Let's say you have an arbitrary write-off policy, and some people do this, and this is, in my opinion, kind of craziness, but they'll say anything after 90 days, just kind of gets written off. That's going to really hurt your money in the bank and doesn't make any sense to me, but understand that'll make your days in AR look great. And understand this too, that the reason days in AR, another reason I would not overemphasize this is because there's a real quick and dirty way to fix days in AR, and that's just to write things off, right? Because that's going to bring your 8 days in AR down, but it's also going to bring your money in the bank down. So the median for professional is about 40 days, hospital-based groups. For global imaging centers, it's about 35 days. But you see these things all over the place. Another war story talking about all over the place. Here's a group about 30 plus rads. They're in-house billing. They're a mixed group in that they have some global and some professional billing. A couple busy centers and docs working in hospitals. So this one, they had about $15.5 million in AR, which is very bloated for a group of this size. They had days in AR over, they had AR over 180 days old of $6 million. Days in AR is about 95, going back to that previous KPI we just talked about. They had credit balances of $600,000. Credit balances meaning money that you owe to patients or insurance companies. This is money you owe. That they, at the time that I became involved, they had about 6 months in backlogs charges, had a file drawer full of uncashed checks, and the real problem here was that the docs were trusting the practice manager, and the practice manager was protecting an incompetent billing staff. So it was they had good software. They had a Ferrari for a software system that they were driving like a lawnmower. So it was pretty ugly. After about 2 years, though, days in AR had come down to 39, which is quite acceptable. Net collection percentage, which we talked about before, had consistently been over 100%. Now, maybe you'll ask me, why? How can you have a net? If it's only possible to collect $1, how do you collect more than $1? Well, that's because you've got a big AR backlog and you're working that money down. So for 2 years, this group had a net collection percentage well north of 100% because they were working down that old AR, and credit balances fell from about $600,000 to $150,000, and all their charges and payments were current. So a great success story, and they were a group that just needed some direction and to put some basic policies and procedures in place, and then to just work your tail off to get this backlog down. So there's a problem with small groups, really small groups. This is not a small group, but there are problems with small groups self-billing, right? Because you get it's a very complex environment, and if you only got 5 or 6 people on your billing staff, it's very, very hard to have that depth of understanding of all the different nuances of this. It's hard to you kind of lack resources, and there's plenty of things that are so complex right now, PQRS and upcoming MIPS and so forth, that are going to make this a very difficult environment to work in if you don't have a big staff and you're not a larger size group. So let's talk for a second about what your billing entity, whether it's internal or external, should be providing you. I think you should at least get an end of month report that has 12 months of comparative data of procedures, charges, adjustments, payments, and AR. And you basically should be able to scan across this sheet and see what's going on with the trends. You definitely want to see what's happening in terms of write-offs. You want to see where that money is being written off and why. You want some basic metrics, the ones we've talked about, net collection percentage and days in AR. It's nice if you can get a patient mix report so you can kind of see what's going on in terms of patient mix. And at least quarterly, you probably want to have a PQRS report telling you how successful you are with this metric. Are you on target to meet the metric, or are you missing things? And if so, how are you going to get that fixed? Because that can eat into your profits quite a bit. So I prefer to give my clients a one-page in a month report and start from there. But you might have some very specific things you need depending on your situation. You might need reports by location. Maybe you have some spiffs for docs based on productivity. So you'll need an RVU report or something like that. They should be able to give you any kind of report that you basically need. But what I would tell you is there's a lot of groups out there, far too many groups that don't get any kind of reporting, and the reporting that they get is so bad they can't tell what's going on. So what I tell you is just start off small with some basic things, and then add to it as need be. And look for trends in AR, look for trends in payments, and compare where you are to the known metrics that I provided to you. So here's just a quick sample of an end of month report that I think is pretty good. This comes standard in Imagine software. As you see at the top, it gives you your number of patient charges, gives you the charges, gives you the adjustments, gives you the payments. Pink line that they're running through there gives you your change in accounts receivable. And then the yellow line gives you gross collection percentage, which we didn't talk about, and net collection percentage, which we did talk about. The next section, accounts receivable, gives you your total AR that you can watch and gives you your days in AR, and then bad debt. So this is an example of what I think is a good starter end of month report that, for the most part, I can look at something like this and it'll raise more questions that I'll have to dig in deeper later on, but at least I'll be able to spot where the questions and the problems and stuff are. So this is a good one. Insider tricks. Let's talk about that for a second. So this is what some billing companies are doing out there to pull the wool over your eyes, or not treat you the way you should be treated. One of the things they do is they'll use not use RBMA standard metrics. So what is the RBMA? The RBMA is a Radiology Business Management Association. They have standard metrics for net collection percentage, days in AR, et cetera, that they use. And so sometimes you'll be reading these reports that people give you, and it's pretty easy to tell they're not using the RBMA standard metrics. And so why is this important? Because it's important you compare apples to apples. If you're comparing days in AR, for example, and somebody's using data service to start the aging, or somebody is using the post date for starting the aging, and that's going to make a difference in what your days in AR is. So it's just important that you're comparing apples to apples on that. Number two, and this is a big one, and this is, in my opinion, just fraudulent, and that is they put down write-offs, and write-offs are things that are uncollectible, or things that are going to a collection agency because the billing company couldn't collect it from the patient. And they're putting those as adjustments. And adjustments, again, are those contractual agreements that you have with the insurance companies And they do this to inflate the net collection percentage. So it looks like you get this great deal. You're collecting 96 cents on the dollar, but in actuality, it may be considerably lower that because they're where they should be saying, no, this was something we didn't collect that we should have collected. And again, the RBMA has specific formulas that says this is a write-off and this is an adjustment. So that's important to know. The third thing is one of the tricks I've seen out there is over-reporting. So not only will they give you an end-of-month report that's meaningless in terms of the data that's in there, but they'll just give you volumes of it. I've seen end-of-month reports with 100 pages in it, and they're just trying to overwhelm you with the data so that you won't get anything out of it. Again, to me, when it comes to reporting, less is more. Get good data, the right data in front of you, understand it, what it means, rather than just getting a whole ton of reporting that you don't know what it means. So, and then one of the other real common things in this industry is for people to leave with a low rate. Get you in a low rate, tie you in for 3 years, and then 3 years later you're going to leave them, but they don't care. They've made money. Because one of the things about rates is this, and I'll tell this to people. What do you want your rate to be? The way I calculate my rate for my clients is I put together all the resources that I need to get the collections where I think they need to do to optimize the collections for that group, and then I back into the expenses it's going to cost me. I add some for profit, and I come up with a fee. So when people come back and they say, well, your fee is too high, I say, well, what do you want the fee to be? I could bill for 1% and make money. You won't be happy with you might be happy with the 1% rate, but your total cost of billing when everything is added together is going to be enormous because you're going to be leaving so much money on the table. So don't let people come in with a low rate and get you into a substandard service because that happens a lot. Here's another war story. Some data here in front of you can take a look at. 4RAD's outsourced billing, hospital-based group. So as you can see there, AR is slightly going up, then there's a drop in month 5, and then it goes up again. Look at their days in AR. So their month 1, their AR goes from 425,000 to month 2 to 490,000, but their days in AR drops from 89,000 to 89 days to 31 days, and they're writing off money at the same time. How does that make any sense? It doesn't make any sense. It's what's happening here is a couple of things. One, this particular billing company was using a non-standard RBMA formula, and they were calculating days in AR on a month-to-month basis. But they're also doing something here that is not possible, or they're reporting something that is not possible. They have a net collection percentage of 110%. Now, remember, I told you having a net collection percentage of over 110% is possible. But the only way that's possible is for you to be working down AR. This group's not. So how can you go from $425,000 in month 1 to $600,000 in AR with write-offs and have a net collection percentage of over 110%? You can't. That's the bottom line. They're taking write-offs as adjustments, and that's how they're doing it. So know what you're looking at. And if you don't know what you're looking at, get somebody that does know what they're looking at and look at these numbers, because you can obviously see from this example, if you know what you're looking for, that somebody's doing some stuff here that is not right. So I would tell you this: radiologists are pretty notorious for looking at very odd things when it comes to selecting a billing company or deciding what they're going to do with their billing. They look at the fee, they look at the location, they look at the size of the company, etc. What I tell you is look for people that have integrity. And I know that's a hard thing to do, but Look for people that do what they say and say what they're going to do. Because if people are not pursuing your money the same way that you would, you've got a problem. It's easy money out there if you want to lead with a fee and not do a very good job on collection. There's easy money to be made out there. And you'll develop a reputation, and there are companies out there that do have reputations. So just look for people that have integrity is my advice to you. I have this thing, I call it Kyle's 10 Commandments of Billing. And I'm just going to read them to you. I sort of took a liberty with the biblical 10 Commandments and sort of made a 10 Commandments of Billing. So use a little King James English there. But anyway, it says, thou shalt not do things the easiest way or the quickest way, but the right way. If thou touchest an account, thou shalt clean it up. Thou shalt be tenacious in collecting as if it were thine own money. Thou shalt not lie, cheat, or steal, but be honest and trustworthy in all we do. Thou shalt be courteous and professional in all that thou doest. Thou shalt be current on everything. Thou shalt practice triage, and that thou do the most important things first and work down from there. Thou shalt be compliant in coding, privacy, general accounting principles, and the law. Thou shalt answer the phone within 2 rings. Thou shalt be a positive influence in the office by maintaining a positive attitude, being a team player, helping those around you, avoiding gossip and other detrimental behaviors. And I give this to all my employees. Now, does a billing company or a billing staff have to have a written thing like this in order to be to operate with integrity? No, they just need to live these principles, right? But if you I would just say this: if somebody's willing to cheat for you, they're willing to cheat you as well. So just make sure. One of a nice question to ask a billing company is get a coder and get a kind of a gray area coding question where the biller, you haven't really dictated the right information, but it's fairly obvious that something has happened beyond that. So in other words, what I'm asking you to do, if you're looking for people, ask them a question about how they would code something. Would they upcode something that hasn't been dictated? Would they ask for an addendum, or would they not code it? So the right answer, I think, is depending on your billing policies, is to ask for an addendum. Because if the answer is, oh yeah, I'd upcode it for you, well, that's fraudulent, right? And you don't want somebody coding for you, working for you, that's willing to cheat anybody. So don't use those kind of folks. Another war story. Here's a 30-plus rad hospital-based in-house billing company. They were struggling a little bit, but things looked kind of average, right? In 2012, 87% net collection percentage, not bad, above average for a hospital-based group. Days and hours, a little high, but nothing to get shocked about. At 52 days, they are of 120 is a little high, but not not crazy high, but it was a little high. And 2016 now collected 98%, and days in AR over 120 is 11%, and days in AR is 25 days. So there are improvements to be made in certain groups, and again, you have to kind of understand what's going on behind the scenes. But in this case, this was a group that could have been very, very content being average or hitting the median, right? Because they were close. But in this case, they benefited a lot by making changes. So where do you guys mess up when it comes to billing? One of the first things is, and hopefully you're getting educated here right now enough to keep a watchful eye on things, but you don't know enough to look at reports and spot the problems. Okay, you need to know just that minimum. Be able to look at a 1-pager, 2-pager end of month report and know what you're looking at, understand the numbers and what they mean. Another thing you guys do, I've mentioned this before, is you chase the lowest fee. The lowest fee may be the best bid you got, but it may not be either. You need to look behind the scenes and see how they do things. And are they add in a bunch of add-on stuff to it too. Another mistake you guys make is thinking average equals good. It may, but it may not as well. Another thing you guys need to look at is the big picture. Things like PQRS. If somebody is not uh, coding PQRS, not helping you establish what measures you're going to do, not looking out for you on what's coming with MIPS and all this, and not a teammate with you, you're probably not getting what you're paying for. So make sure you look at the big picture that you're going to be made whole in the whole process of billing. And again, the deal is just the deal, but don't just look at the rate you're being charged, because a lot of companies will add a whole lot of add-ons. And I'm not saying this is bad. They'll charge you for credentialing, they'll charge you for postage, they'll charge you for this or that. And that's okay as long as you know what the cost of billing is. So don't, somebody provides you an all-inclusive rate and somebody else provides you a rate with all these little add-on fees. Just make sure you add on those fees when you're comparing apples to apples. Another mistake that is made in this arena is people are too trusting. They trust the practice manager, an accountant, or a friend, president of the group, whatever the case may be. Just make sure that you're kind of looking behind the scenes and you know what the numbers are, and don't take people's words for it. I've seen a lot of groups that have really struggled because they put too much trust in a practice manager who wasn't doing their job. Another thing that's very common in this industry is for the practice manager to be placed there and an employee of the billing company. I don't think that's a good idea. It's it's the fox watching the hen house. I just don't think that's good policy. You want your practice manager to be watching over your billing company, not an employee of your billing company. Another mistake I see all the time is when people are going through the process and they're getting bids and stuff is, they'll get these very, very impressive people that come in for the proposal presentation that they will never see again. So just make sure that, the person who's going to be running your account, whatever their title is, account manager, or, whatever, make sure part of the process that you meet the person that's going to be in charge of your account, the person who you're going to be picking up the phone and calling if there's a problem or issue or question. So that you see that a lot. People also buy into false indicators of success. Oh, this company's big, everybody uses them. This company's small, they're going to be, very, high customer service because they're small. They've got an impressive customer list. These guys have, somebody that's, well known in my area or something. Let me tell you, in my experience, there are really, really bad billing companies that are small. There are really, really bad billing companies that are big. There are really, really good billing companies that are small or that are big, and you just have to do the due diligence and don't assume that these bogus indicators are the probability of success. So, and then last of all, make sure that they're flexible. One of the easiest things to do as a billing company is to set a very, very strict process, and that's your process, and you don't change it for anybody, and that keeps your costs low. But, I really feel like there needs to be some flexibility here on working towards your needs and what it is you need. So make sure that whoever you're dealing with, they're working to meet your needs and not setting things up so that it's convenient for themselves. And then, so, the last thing I'll just say here, things that make for good billing, as I said, integrity, people that say what they mean and do what they say, teamwork. Don't think you can kind of, sign up with somebody and wash your hands and walk away. You need to stay involved. You need to work together as a team. The best billing company in the world, can't get you good results if you're not cooperative. If you're dictating sloppily, if you're giving incomplete information, they're just not going to be able to give you good results. So work as a team, understand that, you've got to stay involved. This is kind of a throwaway comment, but it's important to make sure that, the people you're working with are compliant. I think that's an important thing, and some people just hate to hear the word compliance, but it's not a problem in case it jumps up and bites you. So make sure that they got a compliance plan, have a chief compliance officer that they're on top of that. Make sure that the people that you're going to be working with are going to be successful in the things that are important to you, like PQRS. If their customers weren't getting their money last year, if they had a 50% success rate last year, why would you expect them to suddenly turn that around the next year? Make sure that they've got a good track record in doing things like that. As I mentioned, plain, easy to understand, accessible reporting. And, if you say, I want this information, for the most part, they should be able to give it to you, unless you're asking for stuff that's not contained in the billing data. They should be able to pull it out and give it to you in some sort of a way. I recommend certified coders. That way that they know what they're doing. And there's two organizations, AAPC and RCC. RCC is radiology specific, but I think certified coders are important. And I'll throw in here too, if you're doing interventional procedures, I would recommend a certified interventional coder. They've got them, and interventional is hard to code, so you need somebody that really knows what they're doing when it comes to that. So if you're a heavy into interventional in your practice, just ask about that. Who's going to be doing my interventional coding, and what's their experience level? Make sure that people have good software. There's a lot of old software out there that whose time has come and gone. There's a lot of non-specific radiology software out there that doesn't use RBMA metrics and so forth. Just make sure people have good, reliable software behind them. And make sure, you might want to place a phone call in the process of looking for a billing company to see what the patient experience is going to be like. You don't want your patients to get an endless phone tree. You want people to answer the phone to be able to help them immediately. You want to have a good patient experience. That's the sum total of what I had to share with you today. On each one of these slides, it's been my contact information, my cell, my email. Feel free to reach out to me and ask any questions you might have about this. If it's a simple billing analysis, send me an end of month report, and I'll do a quick billing analysis for you. It won't cost you a dime. If you want me to do something more involved, come on site or dig into a whole lot more reports and fairly straightforward end of month report. Might result in a consulting engagement, but look, we're all in this together. It's a difficult area, and I'll do what I can to help you all. I wish you the best of luck, and thanks for your time.